Now to our weekly market monitor, who says she has 3 stock picks that could weather a potential market correction. The last time she was on in March, she recommended Amgen, which is up 4%, Johnson & Johnson higher by 6%, and Abbott Labs is up 15%. Joining us is Nancy Tengler, Chief Investment Officer at Heartland Financial. Welcome back, Nancy. Nice to see you again.
Thanks for having me, Sue.
Let's get to your picks. Texas Instruments, #1 on the list. Why?
Yes, so this is a company management team that was very wise and diversified away from the mobile space into industrial and auto chips. So they're the largest analog chip maker. And in doing so, they lowered their cost structure, improved their margins, and promised to return 100% of free cash flow to the shareholder, which they have done. Dividends are up 25% over the last 5 years on an annualized basis. Yesterday, they announced a 24% dividend increase, and expectations are for another 20% next year. So total return to the shareholder has been quite robust, and we expect it to continue.
Home Depot, I mean, this has been sort of the darling of the home improvement sector. And I wonder, and you like this, and I wonder how much of that is also influenced by the impact of the big hurricanes we've seen recently and the need that the company is going to be able to fill.
Yes, well, that's one of the unfortunate benefits to Home Depot, and we still continue to wish our fellow citizens very good luck in getting things back on track. But in addition to that, Bill, the company benefits from 2 things. One is, I do believe they're Amazon proof, despite the fact that Amazon is interested in selling appliances and plans to online. Home Depot has built up a very fast growing e-commerce business. It grew over 20% in the first half of this year and 16% last year. But more importantly, the American home stock is aging. 2/3 of homes are 30 years or older, half are 40 years or older, and the average home improvement cost in that range is about $3,500 a year. So Home Depot, while it has had a nice run, has a great yield, has raised its dividend in the 20% range over the last 5 years, and is an extraordinarily well-managed company.
Our last pick tonight, XLP. It's a consumer staple spider ETF, kind of an insurance policy, you say.
Exactly. Against a correction, no one likes that space right now because the market keeps going up and those stocks are just sort of sitting there. But if you look back on the last bear market we had, January of 08 to June of 09, that ETF went down half as much as the market. And over the full cycle of that bear market, it actually was up 25% when the market was down 2%. So this is not, if you think the market is going to continue to go up forever, then this is not necessarily the place you want to be. But if you think that there is room for a correction, these stocks and this ETF in particular will stabilize with a 2.7% yield, and companies that grow their earnings kind of 5% a year, very stable.
It's always good to have an insurance policy, right?
That's
Thanks,
right.
Nancy. Have a great weekend. Nancy
You too,
Tengler
Sue. Thanks,
with
Bill.
Heartland Financial.